Hey everybody, I thought I'd just make a quick comment regarding just market conditions, what's happening, what are we talking about around the office here, and just what's been happening in the world of the stock markets. You know, so far year to date, a couple interesting things. Saw this article in the Wall Street Journal today. I thought I'd comment on it. It started off, of course, you know, we've had a couple down days on Wall Street, and as Ira likes to say, who runs Murfreesboro and Mount Juliet, he always says, you know what, you don't want markets that go straight up. Because number one, you're buying stocks at a bigger price and a higher price tag each time that you buy if the stock market keeps going up. And number two, if the market always went up, then what would happen is the risk premium would go away. In other words, if stocks always went up in value, there would be no extra expected rate of return of owning them. So yeah, there's always a bright spot in some of these things. But I thought it was interesting. This article had an opening paragraph that said this. It said, stocks, commodities, and the euro stumbled as investors braced for a long period of uncertainty about European credit that could translate into weaker global economic recovery than anticipated. A couple things about that. You know, markets will go down as people start to digest uncertainty. Well, think about what does that mean? Well, that means that if we have this price, if a stock is selling for this price, and all of a sudden there's more uncertainty or more concern or more worry about the future, investors will do this. Always remember, when somebody sells something, there's somebody on the other side buying that thing that they're selling. And what they're doing is they're buying at a lower price. Why? To build in for themselves a greater expected return in the future. In other words, when something is selling for this price, it doesn't have as far to go up. When it's selling for this price, it has much further to go up. In other words, what investors are doing is building in for themselves a greater return to compensate themselves, if you will, for the risk taken. That's how investors operate. Now, another thing that's happening, you may be seeing something that's kind of interesting as far as the dollar strengthening versus other currencies. What that means is that when the dollar strengthens, it takes less dollars to buy something from overseas. So in other words, what's going on, international stocks are getting cheaper relative to U.S. stocks. So I was looking at returns year to date for an entire diversified portfolio, both U.S. and international. And I noticed that the U.S. stocks are a lot stronger, but they're a lot stronger in a very interesting area, small and small value. The S&P 500, which is what everybody follows really, is done fairly well. It's done fairly decently this year, but the real strong point is those areas that you don't typically find in investment portfolios, which is small and small value. So I thought it was very interesting to see that that was so strong. International, fairly weak. Now, why is that interesting to me? Well, because now we're hearing about financial advisors telling their clients to increase their international exposure. A little bit too little, too late. That's what they should have done 10 years ago. So anyway, just thought I'd give you a little update. Have a great day. We'll catch you next time.